It's Monday, March 20th. Hello, King community. Welcome back to the Kingcast. I'm your host, Frank Roach, presented by the Economics Division of the Social Sciences Department. This is King Economic Research coming at you. Normally, we don't produce a Kingcast or a weekly market report when we have vacation on a Friday or a Monday, but it's too many weeks now have gone past. We must get the February monthly economic report to you before the month of March ends. Remember now, economics is always backward looking, and our most recent available data is for the full month of February. So that's why we are always looking backwards. And that's okay. The best predictor of the near future is the recent past. Normally I have Jack Zipper with me today, but again, we are on vacation. I don't want to disrupt the students from their enjoyable time off. And so I thought we'd present this to you solo this month. Sorry to say my camera is not operating today, but that's not going to stop us. I'll put up a picture of myself you can enjoy for the balance of the Kingcast. And of course, you can always not look and just listen. So we do the monthly economic report this year. Our month in focus today is the February report. But before we do that, we have to talk a little bit about banks. What's going on in the banking world across America today, this little banking crisis that has developed. We've had this second and third largest bank failures in American history over the past week or so, kind of out of nowhere. And so I just wanted to touch base with everyone, and I know there's lots of concerned depositors out there that are worried about what might happen to their bank deposits. We'll touch on that a little bit before we get into the main body of the February monthly economic report. Consider for now, it appears everyone's deposits are safe now that the federal government has gone all in on backing everyone's deposits. Just took 24 hours for that to happen after decades and decades of the FDIC insuring $100,000 and $250,000 of our deposits. Nonetheless, the ultimate challenge for banking is the type of banking system we have put in place. It's a banking system that's been in place for hundreds of years around the world, and it's a fractional reserve banking system. And that is a notion that the deposits we put in the bank for our needs in terms of transaction needs, paying our bills, and of course, saving money, is such that once we deposit our money into the bank, 90% of that is lent out or invested. Only 10% of our deposits are on hand available to us at any given time. And if we all rush to get them at the same time, they simply will not be there. In order for banks to meet excess demand for deposits that go beyond their reserves, they have to sell assets or call back loans to get that money available to give back to their depositing customers. Right now, as I mentioned, between 10 and 13% is all the banks have to hold as reserves. That is to say, they have to keep them in vault cash or on account with the Federal Reserve, available for you and I to walk into the bank and withdraw our cash. So you can imagine, with that very low number, it doesn't take much for them to get into trouble in terms of people wanting their money back. And we think of large depositors, think corporations, hedge funds, venture capital funds, like what we saw happen with Silicon Valley Bank and Signature Bank and First Republic Bank. They have deposits way above the current FDIC limit, Federal Deposit Insurance Corp limit, which was in place prior to a week ago Sunday, was $250,000. Above that, you're on your own. And so that is the risk of the US banking system. And more importantly, the risk of large depositors pulling their funds quickly and causing trouble for the balance between deposits and assets for a given bank. So let's check in real quickly on this banking crisis as we've seen over the past week. The three banks in focus have been Silicon Valley Bank, the first bank to go down, Signature Bank, and First Republic Bank. First Republic hasn't been taken over into receivership yet. Signature Bank and Silicon Valley Bank have. And of course, what the Biden administration did a week ago Sunday has mitigated a lot of concerns on the part of depositors, large and small. And so we'll just pick up with, contrary to what President Biden said last week and has said throughout the past week, the actions taken by the Treasury, the FDIC, and the Fed, what was that, Sunday the 12th, is in fact a bank bailout and is in fact going to be on the taxpayer. The bailout is to the tune of about $9 trillion, ensuring all deposits, large and small. Deposits from the mom and pop, all the way up to deposits to the sophisticated investor and financial player. The questions, of course, raging throughout the week was who is to blame. One thing I can say for sure that is not to blame, and that's the Federal Reserve contractionary monetary policy that has been underway since March of 2022. That is to say, the Fed has been reducing the money supply and raising interest rates since March of 2022 to reduce output, to bring down the rates of inflation, as they're compelled to do for their dual mandate, price stability. The Fed could not have been more transparent in the months leading up to March 22 and since about what they are doing with the money supply and interest rates and why. All banks, including Silicon Valley Bank and Signature Bank and First Republic Bank, hold treasury securities as assets. And they all had plenty of time to notice what was going on with respect to Fed actions and what would happen to bond prices, which is to say bond prices fall as interest rates rise. So that is definitely not to blame. The Fed has gone through many tightening and weakening cycles, expansionary, contractionary cycles since 1913. The vast majority of banks manage these processes very easily. But unfortunately, poorly managed banks, banks without good risk management, banks without the C-suite paying attention can get in trouble. And the other notion that the Federal Reserve has raised rates too high is, again, just not supported by history. The best we can say about what the Fed has done so far with the federal funds rate and money supply is to normalize interest rates, to bring them back into a range that is typical over the past 50 or 60 years. The outlier has been the last 10 years, when the Fed had pegged interest rates at 0. So right now, the Fed is still in the normalization process. Until we get above 6% or 7% in the federal funds rate, we cannot think of the Fed hiking rates too far. Nonetheless, the Fed is on the list of those to blame for this current banking crisis we are seeing across the country. They're to blame for their experimental monetary policy, which began in 2009 under Ben Bernanke's tutelage, involving quantitative easing and their zero interest rate policy. Quantitative easing is injecting huge amounts of money into the financial system, typically by buying treasury bonds, but also by buying agency securities. These are Fannie Mae and Freddie Mac, our housing, loan management, quasi-government entities that issue bonds to raise money to help provide mortgages to people across the country. And then in particular, the lack of action by the San Francisco Federal Reserve Bank, run by Miss Daly, a Janet Yellen apostle. The CEO of the Silicon Valley Bank is actually on the board of the San Francisco Federal Reserve Bank. What many people don't know, of course, is any bank that exists in a given Fed district, and there are 12 districts around the country. Here in Connecticut, we are in the New York Fed district. And all banks that want to exist must take shares, ownership shares, in their regional Federal Reserve Bank. So the relationships between the Federal Reserve Bank and the banks within its district should be relatively close. And Daly's San Fran Fed Bank should have been aware of the challenges confronting Silicon Valley Bank, or at least the gossip, the talk that began some weeks ago when some of Silicon Valley Bank's largest depositors, some of our most sophisticated investors, venture capital funds, hedge funds, large tech firms, began to withdraw their money from the bank in large amounts. That should have been a big clue for everyone. And of course, over the years coming, we'll discover exactly what happened and why this was not noticed. In addition, in reality, the essence is the fault is on risk management policies of the banks. So think the executive suite, think management. Also, the focus of boards being ESG, environment, social, and governance, as a driving force for the actions of a given bank board, instead of profitability, risk management, or what large depositors are uninsured were doing. Also on the list of those large uninsured depositors who weren't paying attention to the financial risk that is endemic in our system. When it comes to management and the boards, the fault was the mismatched portfolios they were running. Borrowing money from you and I, dirt cheap, taking our deposits at very, very low interest rates, and lending that money out or investing that money out in assets that with much higher yields, in corporate loans and treasury securities 2 years and out. Consider Signature Bank, with a borrowing cost of deposits at just 0.88% against earning on assets of 4%. And this is mostly commercial loans, mortgages and leases, and treasury holdings. The difference, that 3.12% spread or earned interest income, generated profits of $3.5 billion in 2022, according to public balance sheets. It only took a few big uninsured depositors, again, the venture capital, tech funds, hedge funds. It only took a few big ones to begin to withdraw their cash for the model to break down at Silicon Valley Bank or Signature Bank or First Republic or many other banks. Which is to say, once they began to withdraw their funds, the banks had to liquidate assets. And in many cases, when we go through tightening and easing cycles by the Federal Reserve, prices of bonds change. And so on a unrealized basis, on a daily mark-to-market method, banks will lose money on their treasury holdings as the price of bonds falls. The premise to this whole thing is that banks hold these securities, these treasury securities, to maturity, at which time they get their full principal back, regardless of what the Fed has been doing in tightening and easing policies. Now, this latest banking crisis is being used by market participants, and some of the biggest at that, to call for the end of the Fed's tightening cycle. This would be a mistake. The Fed's job on inflation is not done. Inflation remains high, as we'll see here in a few minutes when I talk about the CPI, the PPI, and the personal consumption expenditure index. And so the Fed must continue their efforts to reduce demand via money supply reduction and higher interest rates to bring down the rate of inflation. The Fed is scheduled to meet this week. Speculation is they're going to raise the federal funds rate at least 25 basis points to 4.75 to 5%, maybe 50 basis points, but not likely. And the crowd is yelling for the Fed, the speculator crowd, the I need help crowd, stop the stocks from falling crowd, want the Fed to do nothing at their meeting. That this credit crisis is an indication that the Fed has gone too far, too fast in raising interest rates. And it should be noted, every recession is started by a credit crisis related to the inflection points of Fed's monetary policy in managing inflation and employment. The entitled class of stock speculators want the Fed to stop. They don't want to see the S&P 500 go any lower. 401k people don't want to see it. Pension people don't want to see it. But the Fed must ignore those calls. The Fed must continue to increase interest rates to reduce inflation. Real incomes have been falling for 22 straight months. And of course, that impacts the lower end of the socioeconomic spectrum much more than the higher end. All right, that's kind of broad strokes analysis of what's been going on. If you have any questions, of course, see me on campus, send me an email. I'm happy to help. I'm following the story quite closely. So what can you do? What can we do here in the King community to protect our savings, our deposits in banks? Well, as of right now, we don't really have much risk because the Biden administration says they're going to back all deposits. That's not going to be sustainable. We're going to find that out very quickly. This policy they put in place, this patchwork effort to quickly mollify the investment world, will not be the last step. It's very likely that we'll have to rely on FDIC insurance, which is $250,000 right now. So the best thing you can do as a customer of a bank is pay attention. Pay attention to your bank. Now we're beginning to learn that banks aren't always honest publicly, but public banks do provide public information. If you have a local bank, of course, speak with your banker, speak with your teller, keep an eye on local news headlines, and pay attention to the banking world and what's happening with the banking system. Read the news. Then additionally, of course, if you have more than $250,000 in savings in any given bank, spread that around. Obviously, we can get into several iterations of $250,000. Can be a little silly, right? If you can, if you're worth tens of millions of dollars, that's a lot of banks. But paying attention, diversifying your holdings among different banks are two of the best things we can do to protect our savings. Otherwise, engage actively in the debates, the national debates on how the banking system should be managed and the political process around that. We can't escape politics when it comes to banking. Financialization of America started in the 1980s, all related to regulatory changes for the banking world, largely out of Congress. All right, so that's a quick rundown on that. Again, if you want to reach out to me on campus, please feel free to do so. All right, so let's get into the monthly economic report. Again, always backward looking. We're looking at big picture stuff. How's the economy performing? Best predictor of the near future is the recent past. We check in on economic growth as defined by GDP. We check in on the health of the labor market. We check in on inflation. We check in on international trade. And we check in on monetary and fiscal policy. And I'll give you a quick rundown on markets and how they performed during the month of February. So we'll begin with GDP, growth. GDP is released once a month and revised each month for the prior quarter. So in February, we got the second release, which is called the advanced release of Q4 gross domestic product. And in March, we'll get the final release. In each month, they get more information. The Bureau of Economic Analysis gets more information and updates the number accordingly. So for February, real gross domestic product increased at an annual rate of 2.7% in the fourth quarter of 2022. This down from 2.9% from the January release. So this number was revised downwards. The second estimate is based on more complete source data than were available for the preliminary estimate. And the updated estimates primarily reflected a downward revision to consumer spending. Consumers tapped out. Credit card balances are record highs. The increase in real GDP in the fourth quarter reflected increases in private inventory investment, consumer spending, non-residential fixed investment, federal government spending, and state and local government spending that were all partly offset by decreases in residential fixed investment and exports. For all of 2022, real GDP was $20.46 trillion. Not bad. That's real GDP. That's the largest economy on the planet. The next closest country is China, around 14 trillion. All right, a quick check on the labor market. We use the employment situation report as our metric provided by the Bureau of Labor Statistics. For the month of February, total non-farm payroll employment rose by 311,000. Good number. And the U3 unemployment rate, the narrowest measure, edged up to 3.6%, according to the Bureau of Labor Statistics. Notable job gains occurred in leisure and hospitality, retail, trade, government, and healthcare. Employment declined in information in transportation and warehousing. One of the challenges we have with this data is we have to drill down on this information. We find that while 311,000 is a nice number for job increases, we're finding that most of these jobs are low-paying service sector jobs, and many of them are part-time jobs. Have a situation developing where more and more people are working multiple part-time jobs and having one full-time job. And when it comes to accounting for jobs at the BLS, part-time jobs are considered full-time jobs. Anyway, both the unemployment rate at 3.6% and the number of unemployed persons at 5.9 million edged up in February. Among the major worker groups, the unemployment rate for Hispanics was 5.3%, an increase in February. The unemployment rates for adult men, 3.3%, adult women, 3.2%, teenagers, 11.1%, whites, 3.2%, blacks, 5.7%, and Asians, 3.4%, changed a little over the month. In February, the labor force participation rate was little changed at 62.5%. And again, the labor force is not the population of America. The labor force is about 155 million people. Our population is around 330 million. And the employment population ratio held at 60.2%. And again, that's related to our population. These measures have shown little net change since early 2022 and remain below their pre-pandemic February 2020 levels of 63.3% and 61.1% respectively. Not good. In February, average hourly earnings for all employees on private non-farm payrolls rose by 8 cents or 0.2% to $33.09. Not bad if you can get it. Over the past 12 months, average hourly earnings have increased by 4.6%. Now that sounds good. You can hear that. That's a good number. Sadly, inflation rates are much higher than that, so real incomes are down. The average work week for all employees on private non-farm payrolls edged down by 0.1 hour to 34.5 hours in February. So the economy is not bad. Low growth. Employment is suspect. We have some dichotomies building the employment sector. Labor markets appear tight, but something's not quite right. We have some dichotomies developing between non-farm payroll reports, the AD employment report, and initial unemployment claims come out every Thursday. So some uncertainty there. Let's go ahead and check in on inflation and the price level. We begin with the CPI, the Consumer Price Index. The Consumer Price Index for all urban consumers rose 0.4% in February on a seasonally adjusted basis, after increasing 0.5% in January. Over the last 12 months, the all items index increased 6% before seasonal adjustment. So you can see that 4% increase in average hourly earnings, you get the 6% increase in prices, means a negative real earnings. The index for shelter, housing, was the largest contributor to the monthly all index increase, accounting for over 70% of the increase, with indexes for food, recreation, and household furnishings and operations also contributing. This, of course, is driven by rents. And that's what we do rent equivalent mortgages in terms of combining both home ownership and rentals in terms of identifying inflation on housing. And right now, the higher prices for housing is driven by rents. The food index increased 0.4% over the month, with the food at home index rising 0.3%. The energy index decreased 0.6% over the month as the natural gas and fuel oil indexes both declined. Good news to be sure for all of us. That's a result of weakening demand. That's a result of the Fed raising rates and reducing economic output. The food at home index rose 10.2% over the last 12 months. Ouch. I just got my groceries delivered today and I can attest to that. The energy index rose 5.2% over the last 12 months. The fuel oil index rose 9.2% over the last 12 months, while the index for electricity rose 12.9%. Ouch again. How's your electric vehicle thing working out? The index for natural gas increased 14.3% over the same period. Thankfully, the gasoline index decreased 2% over that span. And we can see that at the pumps, right? We go to the gas station. I think I paid $3.09 the other day for regular. Not too bad. Compared. Still way above where we were before President Biden took office. All right, that's the consumer side. Let's check in on the producer side. The producer price index, it decreased 0.1% in February, seasonally adjusted. On an unadjusted basis, the index rose 4.6% for the 12 months ending in February. This is getting better. The PPI is improving quite a bit. It was at 7 or 8% just about 6 months ago. So good signs here to be sure. And again, mostly as a result of the Fed raising rates and reducing economic demand. The index less foods, energy, and trade services increased 0.2% in February after rising 0.5% in January. For the 12 months ended in February, prices less foods, energy, and trade services advanced 4.4%. That kind of matches, while this is the producer side, that's kind of coming close to matching income gains. But again, we don't really evaluate that based on producer prices. And when prices rise at the producer level, the producer has two choices: pass the cost along to the ultimate buyer or reduce their profit margins. Continuing with the PPI, over 80% of the February decline in the index can be attributed to a 36.1% drop in the prices for chicken, eggs. Hey, how about that? Hallelujah. It's about time. I don't eat eggs, but I know lots of people that do, and they've been frustrated by the egg prices. The indexes for residential natural gas, fresh and dry vegetables, diesel fuel, home heating oil, and primary basic organic chemicals also fell. That's good news to be sure. And by the way, when we think of diesel fuel and organic chemicals, think fertilizer, think Russia, Ukraine. So those prices spiked from Feb 2022 through early 2023 and now begin to moderate, which is great news for everybody in the world. All right, we check one more indicator for inflation, and that's the GDP PCE. So this is the Personal Consumption Expenditures Index that comes from the GDP series, a very broad series of data. The price index for gross domestic purchases increased 6.8% in 2022 compared to the increase of 4.2% in 2021. Remember, that comes from the data released from the Bureau of Economic Analysis in February for Q4 of 2022. And so these annualized numbers. The PCE price index increased 6.3% compared with an increase of 4% in 2021. Excluding food and energy prices, the PCE price index increased 5% compared with an increase of 3.5% again in 21. Measured from the fourth quarter of 2021 to the fourth quarter of 2022, real GDP increased 0.9% during the period, compared with an increase of 5.7% from the fourth quarter of 2020 to the fourth quarter of 2021. The price index for gross domestic purchases is measured from the fourth quarter of 2021 to the fourth quarter of 2022, increased 6.2%, compared with an increase of 5.8% from the fourth quarter of 2020 to the fourth quarter of 2021. The PCE price index increased 5.7%, the same increase as from the fourth quarter of 2020 to the fourth quarter of 2021. That's a lot of numbers, a lot of dates. And again, it's a yearly analysis in February 2023 about 2022. But the point is, inflation remains elevated. And the Fed can't stop raising rates at this point, just because C-suite executives and boards can't properly manage risk at the banking level. All right, moving on. International trade. Trade data comes from the census.gov. We're talking about goods and services here today. And one of the things we do get 2 data points each month from the census.gov about international trade. We get trade in goods only, and we get trade in goods and services. The trade in good only deficit is always much larger or lower than the trade in goods and services because we run a healthy surplus in services. So we think of the goods and services deficit, think of a number in the 60s or 70 billions, and we think of a goods number only, think of the high 80s, low 90s in billions in terms of that number. Nonetheless, the U.S. Census Bureau revealed that the goods and services deficit was 68.3 billion in January, up 1.1 billion from 67.2 billion in December. You'll notice now I'm not saying February. And that's because the trade data is always about a month and a half backward looking. It's a very complex number to collect. Lots of variables, lots of imports of goods and services across borders. And so it takes a little longer to compile this data. So it's a little further backward looking. January exports were 257.5 billion, 8.5 billion more than December exports. Good news. January imports were 325.8 billion, 9.6 billion more than December imports. Not so good news. Remember now, our trade deficit is a direct withdrawal from GDP. We think of our GDP equation, C plus I plus G plus NX. That's GDP equals consumption plus investment plus government spending plus net exports. And when net exports are negative, therefore GDP is lower than it otherwise would be. Remember, we're transferring our wealth from our domestic economy to foreign economies. And so a deficit of the types we run really impacts GDP. Some economists argue that that is made up to some extent by increased consumption by consuming lower priced goods from lower cost overseas manufacturing sectors like China. But nonetheless, this is a transfer of wealth from America to the rest of the world. And in 2022, our trade deficit was $1.008 trillion, a new record. And we're looking to surpass that here in 2023 already. The January increase in goods and services deficit reflected a decrease in the goods deficit of 0.6 billion to 90.1 billion, and a decrease in the services surplus of 1.7 billion to 21.8 billion. Wow, that is quite a difference. Year over year, the goods and services deficit increased 19.2 billion or 21.9% from January of 2022. Exports increased 30.2 billion or 13.3%, and imports increased 11 billion or 3.5%. Trade has been a problem for America since 1974 with the Kissinger memo and the opening up of China. It was accelerated in the early 90s with passage of the North American Free Trade Agreement, now the USMCA, the US-Mexico-Canadian Agreement, and was really put on steroids when Bill Clinton and Republicans in Congress passed permanent normal trade relations with China in 1999, allowing them to begin membership of the WTO in 2001. And since that time, America's trade deficit with China has ballooned, and our manufacturing job loss has intensified. And of course, coming out of COVID, we realized how dependent we are on China for many essential goods that we need here in America, or want for that matter. All right, that's trade. Let's check in on monetary policy. The Federal Reserve had a meeting January 31st to February 1st and raised interest rates. So we have some information from their bank statement, from their FOMC statement. Remember, the Federal Open Market Committee is the body within the Fed that sets interest rates and money supply. They meet 8 times a year. As I indicated earlier, they'll be meeting this week to decide to raise rates again. Hopefully, it will not be caused to hesitate by this banking kerfuffle we're experiencing here. The Fed needs to continue raising rates to bring down inflation. Nonetheless, the Fed had this to say: recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and the unemployment rate remains low. Inflation has eased somewhat, but remains elevated. And we have the data to prove that, of course. They talk about how Russia's war against Ukraine is causing tremendous human and economic hardship and is contributing to elevated global uncertainty. And of course, as always, the committee is highly attentive to the inflation risks. The committee, and by that we mean the Federal Open Market Committee, seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. And we're well above that. In support of these goals, the committee decided to raise the target range for the federal funds rate to 4.5% to 4.75%. Now, this range thing is something new that developed in the past 8 years, actually maybe 10 years after the Great Recession. Prior to the Great Recession, prior to this new phrasing, the Fed just set a rate. So call it 4.75%. This range idea really bothers me, and the Fed needs to move away from this. The committee went on to say that they anticipate that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive and to return inflation to 2% over time. In determining the extent of future increases in the target range, they went on to say that the committee will take into account the cumulative tightening of monetary policy, which again has been going on since March of 2022, the lags with which monetary policy affects economic activity and inflation. And we think that's about a 6-month lag. So we're still not fully feeling the impacts of higher rates. And economic and financial developments. Now, this last piece, economic and financial developments, is what the entitled speculators are clinging to as evidence that the Fed should stop raising rates, because financial developments have not been good, as we can see from the second and third largest bank failures in the past week. The committee will be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. All right, so that's the Fed statement from their meeting in early February. Now, the Fed has put in, again, they've worked with the Treasury and the FDIC and President Biden to decide to backstop all bank deposits, insured and uninsured. So for the unsophisticated and the sophisticated, really, really bad move, horrible move, full of moral hazard and very unfair. It will do more to widen the income gap in America, to be sure. The Fed has also put in place a new system to help depository institutions, aka banks, who have access to funds if they need them. A week ago Sunday, the Federal Reserve Board announced it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. This action will bolster the capacity of the banking system to safeguard deposits and ensure the ongoing provision of money and credit to the economy. The financialization of America, credit's critical like never before. The Fed went on to say, of course, they're, as always, prepared to address any liquidity pressures that may arise. And this means nothing more than creating money with a stroke of a keystroke on a computer keyboard, and of course, increasing the Fed's balance sheet even more when they're in the process of trying to reduce it. The additional funding for this provision would be made available through a creation of a new bank term funding program. This is the type of phrasing we heard from the Fed after the 2008-2009 Great Recession, and they put through probably 16 or 17 of these types of funding programs to help the banking system. And again, that's one of the Fed's main roles is to help maintain the banking system. In any event, this bank term funding program offers loans up to 1 year in length to banks, savings associations, credit unions, and other eligible depository institutions. In order to get that money, these banks have to pledge U.S. Treasury bonds, agency debt, and mortgage-backed securities, and other qualifying assets as collateral. So this is more of a real lending program. And this seems a little bit more innocuous than the direct backstop of uninsured depositors. This is something banks have some risk. The Fed gets collateral. So this is somewhat palatable. With the approval of the Treasury Secretary, the Department of the Treasury will make available up to $25 billion from the Exchange Stabilization Fund as a backstop for the Bank Term Funding Program, BTFP. And the Fed does not anticipate that it will be necessary to draw on these backstop funds, which today is almost a signal that says, yes, they will. This is a repetition. This is very much like 2008, 2009, although not nearly as severe so far. After receiving a recommendation from the boards of the Federal Deposit Insurance Corporation and the Federal Reserve, Treasury Secretary Yellen, after consultation with the President, approved actions to enable the FDIC to complete its resolutions of Silicon Valley Bank and Signature Bank in a manner that fully protects all depositors, both insured and uninsured. There's no denying, though, these actions will reduce the stress across the financial system, support financial stability, and minimize any impact on businesses, households, taxpayers, and the broader economy. This news, this story, this information, this event will be on the headlines every day for many weeks to come now. In many ways, when it comes to the banking system in terms of being at risk, it's up to you and I to not panic, to stay rational, do the best we can to protect ourselves without causing chaos. And that's tough to do, I know. And there's anxiety involved and uncertainty in future economic viability. But nonetheless, that's pretty much where we are today. Keep an eye on headlines and pay attention. All right, checking out fiscal policy. What's going on in Washington, D.C.? The federal budget balance for February was minus $262 billion, the widest deficit since July of 2021. We're on pace for fiscal year 2023, which began in October, for another $1.2 trillion deficit. Like nothing now. $1 trillion deficits every year for decades now. Just shocking how not to run a government. Don't talk to me about caring for the children of the future when you run $1 trillion deficits every year. Outlays for the month of February are $525 billion, with the receipts coming in at $263 billion. And it's worth noting here, this is not a tax problem. Tax revenues are at record highs. This remains a spending problem. The budget deficit for February 2021 was $217 billion, so worsened over the year. Also in February, we were supposed to get President Biden's budget. Now, they released that last week, and I mentioned it just briefly, even though it's not part of the February economic report. But the point that should be made with respect to February is the law requires the president to have a budget for the next fiscal year to Congress by the first Monday in February. For the third year in a row, President Biden has failed to do that. Moreover, for the 13th year in a row, the U.S. Congress has failed to pass a fiscal year budget on time. That is to say, by October of a given year. Here we are in March of 2023. The fiscal year began in October of 2023, and we still don't have the budget in place for 2023. That's the debt ceiling debate that's raging in Washington right now. We operate in what are called continuing resolutions. And this is just do whatever we did last time. And it's not a good way to run government. And it's a failure of both our elected officials, our appointed officials, to do their job properly. Anyway, President Biden's budget, $6.6 trillion. Just some reference, in 2019, the federal budget was $4.8 trillion. So spending is up 37% since 2019. And of course, in the budget itself, calculated by the president's team, are $1 trillion deficits for the next 5 years. And again, receipts are at record highs, and it's spending that's really out of control. The president's vision is to build on the work his administration has done to make a real difference in people's lives, investing in America, lowering costs for families, protecting and strengthening Social Security and Medicare, reducing the deficit, and more. Well, they haven't lowered costs for families, and they haven't reduced the deficit. Congress usually ignores a president's budget, especially when the opposing party controls the Congress. And also note the debt ceiling crisis for 2022, 2023 is not yet resolved. All right, that's fiscal policy. Let's have a quick check on financial markets for the month of February. I know you all have your statements, and again, that's something else we want to do carefully as consumers, as investors, as savers, is check our bank statements, our 401k statements, our pension statements regularly. Check in on stocks for the month. The S&P 500 will be our proxy. In February, the S&P 500 opened at 4,076, had a high of 4,179, and a low of 3,783, and closed the month at 3,951, down just 125 points for the month, or down 3%. A lot of range trading in the S&P 500 the past few months. For the bond market, we'll look at the 10-year Treasury bond as our proxy. Opened the month at 3.4%, had a high of 3.95%, a low of 3.4%, and a close of 4%, up 60 basis points for the month. Of course, the 10-year Treasury and stocks have been reversed, right? Treasury prices have rallied dramatically over the past week on the back of this banking crisis. I think the Fed's going to stop raising rates. And stocks, of course, has been on a roller coasters over the past week with respect to different headlines coming out about banks. Checking on the dollar in the foreign exchange market, the U.S. dollar index, a broad basket of the U.S. dollar against other currencies, opened at 101.22, had a high of 105.21, so stronger dollar. A low of 101.22 and a close of 104.48, up 3.26 pips for the month. Stronger dollar is really not helpful for the U.S. economy. That makes our exports more expensive, our imports less expensive. We need some dollar devaluation here to help correct our trade balance. And lastly, we'll check in on commodities. The commodities index opened at 111.80 in February, had a high of 111.80, a low of 105.55, and a close of 107.29, down 4.51 for the month. That's good news, right? Commodities are the raw materials that go into the goods and services we as household, business, and governments consume. And so we get those prices down, we can see improvement in the rates of inflation. All right, that's the rundown for the February monthly economic report. I want to thank you for your attention. Again, any questions you have, reach out to me on campus via email or in person at 321. And we'll close the show as always with our friendly reminders. Do your reading, do your homework, come to class prepared. Hey, use your blinker when making turns or switching lanes. You're going to get into an accident. Stop signs mean stop. I mean, just listen, look at the sign, stop. No texting while driving, you kill yourself, and always try to buy American. All right, that's it for this month. Join us again next month and tell your friends and family. Listen to the KingCast at kingschoolct.org, academics, upper school, clubs, and activities. I'm your host, Frank Roach, and I'm out of here.